is a better investing strategy? Dividend stock investing or growth stock investing? I've been investing in the stock market since 2016, and in this video, I'm going to reveal my preferred investing strategy and the reasons why. Hey lovely people, my name is Simone and I'm just an ordinary investor with the aim of sharing my journey with you and inspiring some of you to start investing too. Firstly, let me explain what dividend and growth stocks are. A growth stock is a share in a company that is anticipated to grow at a higher rate than the average growth in the market. This is because the companies of growth stocks usually want to reinvest their earnings to accelerate the growth of the company. These stocks generally do not pay dividends. When investors invest in growth stocks, they're hoping to sell their shares in the future at a higher price than they bought them for. The only opportunity an investor has to earn money on their dividends is when they eventually sell. Microsoft, Apple, and Nvidia are examples of growth companies, being the top 3 most valuable companies in the stock market in 2024. A dividend is part payment for a company's profits that own stock on a particular date determined by the company, known as the ex-dividend date. Not all companies pay a dividend. Companies usually pay dividends when they're profitable and have excess cash that they do not need to reinvest. Instead, they reward investors by paying them a certain amount of money for every share that they hold. Even if you own a fraction of a share, you'll still receive an apportioned payment. The amount of the dividend is announced in advance before the ex-dividend date. For example, the next Shell plc payment is due in June and will be 27p for every share owned. Dividends are commonly paid quarterly, biannually, and annually. US stocks tend to pay quarterly and UK stocks biannually, although there are a few quarterly and annual payers. Now, this is not financial advice. I'm just sharing my experience with you so you can do your own research. So, I started buying stocks in 2016 by buying stocks based on the recommendations by the Motley Fool, a stock picking recommendation company. You'll find a link to the Motley Fool in the description below. At the time of my investing, they were heavily growth stock biased. I own companies like Netflix, Tesla, Apple, Pinterest, Airbnb, and more based on their recommendations. These companies have grown considerably over time, but I'm down on Airbnb and Pinterest because of when I bought them. However, because of my age, I'm thinking more and more about my retirement and want to secure a steady income month to month without having to sell stocks. This is done by dividend investing. Unlike growth stocks, there's a lower risk of running out of money. With growth stocks, I would need to sell in order to cash out, reducing my capital. The only way that would happen with dividend investing is if all the companies invested in stopped paying a dividend, which is why it's important to have a diverse portfolio, including index funds that pay dividends. Currently, I own a mixture of US stocks, including Coca-Cola, Pepsi, AbbVie and Johnson & Johnson, and UK stocks, including Legal & General, Rio Tinto, UK Greencoat UK Wind, and National Grid, and UK index funds, all which pay me a dividend. I also prefer dividend stocks because when I'm no longer here, they will pass on to my daughter, who will keep benefiting from the income, and she can pass them on to her future children, along with the portfolio that she's also building for herself. That's how generational wealth is built. In my opinion, relying solely on growth stocks leaves you at the mercy of the volatility of the stock market. And you may get caught having to sell your stocks during a bear market. That's the point when the stock market prices are falling. As an example, if you wanted to cash out £3,000, say, at a time when the share price is £500, that means you'd have to sell 6 shares. But if the stocks had gone down to, say, £300, then you'd have to sell 10 shares in order to get that £3,000, leaving you with far less shares. This leads to uncertainty, whereas with dividends, you can calculate how much you'll be paid each month by dividing your annual dividend income by 12 and adjust spending accordingly. With dividend investing, I'm not worried about the stock price because whatever the price, I'll keep getting paid the dividends. The price doesn't affect the amount of dividends that you get paid because it just depends on the number of shares that you own. The downside with dividend investing, however, is that the compounding really doesn't start to take off until after 20 years. So, yes, it's a long term strategy. Which investing strategy do you prefer? Comment in the comments down below. I'd really love to hear your thoughts. At the present time, I receive a small monthly income from dividends, which I use to reinvest into whichever company is paying a dividend next. Click on the video above to see how much I got paid in dividends in the month of May. I hope this video has provided you a little bit of an insight into growth and dividend investing. Thank you very much for watching, and I'll see you next time.